It's happening quietly, strategically, and with consequences most people won't understand until it's too late. While headlines distract the world with short-term noise, two of the largest geopolitical players on the planet, China and Russia, are making a move that speaks louder than any press conference. They are dumping U.S. Treasuries, nearly $1 trillion worth over time, and redirecting that wealth into one asset that has outlived every empire in history: gold. This isn't rumor. This isn't theory. This is a shift in confidence, and confidence is the real currency of the global financial system. Ask yourself this: when the world's biggest creditors start walking away from government debt, what do they know that the average saver doesn't? Treasuries have long been marketed as risk-free, the ultimate safe haven. But safe for whom and for how long? China and Russia are signaling something profound. They no longer trust the long-term stability of paper promises backed by expanding debt, political polarization, and unlimited money creation. And when trust erodes, capital doesn't argue, it moves. This isn't an emotional decision. It's a calculated one. Both nations understand that debt-based systems eventually reach a tipping point, where servicing the debt becomes more expensive than sustaining growth. The United States now pays more in interest than it does on many essential public services. That is not a political statement, it's a mathematical one. History teaches us that when math and politics collide, math always wins. China and Russia are positioning themselves ahead of that reality. Now, here's the part most people miss. They're not just selling treasuries, they're buying gold aggressively. Gold doesn't depend on another nation's promise. It can't be printed, sanctioned, frozen, or inflated away. It's neutral, it's scarce, and it's trusted globally. When central banks accumulate gold, they're not chasing profit, they're preparing for stability. They are insulating their future against a system they believe is becoming fragile. Think about the symbolism of this move. For decades, global trade revolved around the U.S. dollar. Treasuries were the backbone of reserves. But now, the world is fragmenting. Trade is becoming regional. Alliances are shifting. And monetary power is slowly decentralizing. Gold becomes the bridge asset in that transition. It doesn't belong to the East or the West. It belongs to whoever holds it. This is where the lesson becomes personal. Because every major wealth transfer in history punished those who ignored the signals and rewarded those who paid attention early. This is not about panic. It's about awareness. When institutions with centuries of historical memory start preparing for uncertainty, individuals should at least ask the right questions. What does real security look like in an era of rising debt, currency debasement, and geopolitical tension? Here's the hook you need to hear. By the time the shift becomes obvious, the opportunity is already gone. Gold doesn't explode overnight. It revalues quietly as confidence in everything else fades. That's how it has always worked. Those who waited for confirmation paid higher prices. Those who acted on signals preserved purchasing power. What we are witnessing is not a temporary adjustment or a political gesture, but a calculated structural shift in how major powers perceive monetary security. China and Russia's reduction of U.S. Treasury holdings reflects a long-term strategy aimed at minimizing dependence on a single currency system that they no longer view as neutral or stable. This process, often described as De-Dollarization, is unfolding gradually by design because large actors do not exit dominant systems abruptly. Instead, they quietly rebalance, step by step, before the consequences become visible to the wider market. For decades, U.S. Treasuries functioned as the backbone of global reserves, not because they were flawless, but because there was no credible alternative. That reality is now being challenged. Persistent fiscal deficits, rapid debt accumulation, and repeated episodes of monetary expansion have altered the perception of the dollar's long-term purchasing power. When reserve-holding nations observe a system where debt grows faster than economic output, the rational response is not protest, but protection. And protection begins with diversification. Here's the critical hook most people overlook: confidence is the true reserve asset. Once confidence starts to erode, even slightly, the smartest capital moves first. China and Russia are not betting against the United States in an ideological sense. They are hedging against concentration risk. Any portfolio manager would recognize the danger of holding excessive exposure to one issuer, especially when that issuer controls the currency in which the debt is denominated. Sovereign investors operate under the same logic, only at a scale that reshapes global flows. This shift also reflects a deeper geopolitical reality. Financial infrastructure has increasingly been used as a policy tool, turning payment systems, reserve assets, and currencies into instruments of leverage. For nations seeking strategic autonomy, reliance on dollar-based reserves introduces vulnerabilities that extend beyond economics. Reducing Treasury exposure becomes a form of risk management, insulating national balance sheets from external political influence while preserving long-term financial flexibility. Another hook worth paying attention to is timing. These moves are happening before a crisis, not after one. History shows that the most consequential relocations occur when markets still appear calm. By the time de-dollarization becomes a mainstream topic, the adjustment phase is already well underway. China and Russia understand that reserve transitions are slow, asymmetric, and irreversible once momentum builds. What makes this moment especially significant is that it sets a precedent. When large economies demonstrate that alternatives to dollar-heavy reserves are viable, others quietly follow. This is how dominant systems evolve, not through collapse, but through gradual dilution. The selling of treasuries is not an attack on the dollar's present role, it is a statement about its future share. And in global finance, the future is always where the real decisions are being made. The accelerating rise in sovereign debt has fundamentally altered the risk calculus surrounding government bonds, particularly U.S. Treasuries, which have long been treated as the global benchmark for safety. What once functioned as a low-risk anchor for portfolios is now being reassessed under the weight of expanding fiscal imbalances and a rapidly growing interest burden. This is not a theoretical concern or a distant scenario. It is a measurable shift unfolding in real time, driven by arithmetic rather than ideology. Here is the first hook that demands attention. Debt does not become dangerous when it is large, but when it becomes expensive to maintain. As interest rates normalize from historically low levels, the cost of servicing outstanding debt rises sharply. Governments that relied on cheap borrowing for decades now face a very different environment, where refinancing maturing obligations requires significantly higher interest payments. When a growing share of public revenue is redirected towards servicing past debt, fiscal flexibility narrows and long-term stability comes into question. The perception of treasuries as risk-free has always been conditional. It depended on confidence in the issuing government's ability to manage debt sustainably without resorting to excessive monetary expansion. However, persistent deficits and repeated reliance on central bank intervention have introduced a new layer of uncertainty. Investors are increasingly aware that inflation, not default, is the more likely mechanism through which debt is resolved. That realization reframes risk entirely, because inflation quietly erodes purchasing power even when nominal payments are honored. Another critical hook lies in the feedback loop between debt and monetary policy. As interest expenses climb, political pressure grows to keep rates suppressed, creating tension between price stability and fiscal sustainability. This dynamic can compromise central bank independence, blurring the line between monetary discipline and fiscal accommodation. For long-term investors, this raises a crucial question: if maintaining debt affordability requires ongoing monetary intervention, what does that imply for the real value of fixed income assets over time? From a global perspective, rising interest burdens also reshape capital allocation decisions. Foreign holders of sovereign debt must weigh not only yield and liquidity, but also currency risk and long-term real returns. When yields fail to compensate for inflation and fiscal uncertainty, the rationale for holding large quantities of government bonds weakens. Capital, by its nature, seeks preservation first and return second. The most important insight is this: markets adjust expectations before they adjust prices. Subtle changes in demand for sovereign debt reflect deeper reassessments of sustainability that are not yet visible in headlines. When major reserve holders begin to reduce exposure, it signals that the cost of debt is no longer being viewed as manageable under existing assumptions. This is how systemic shifts begin, not with panic, but with quiet recalculation. Gold's renewed prominence in sovereign reserve strategy reflects a fundamental reassessment of what safety truly means in a fractured global system. Unlike financial assets that rely on legal frameworks, payment networks, or the policies of issuing governments, gold exists outside the architecture of modern finance. That independence is precisely what makes it attractive at a time when economic instruments are increasingly intertwined with geopolitical power. The hook here is simple but powerful: when rules can change overnight, assets without rule makers gain value. For decades, Efficiency and yield dominated reserve management decisions. Liquidity and return were prioritized over neutrality because the global system appeared predictable. That assumption no longer holds. Sanctions, asset freezes, and restricted access to payment systems have demonstrated that reserves held within another nation's financial infrastructure can become conditional. Gold, by contrast, carries no counterparty risk. It does not depend on another government's solvency, goodwill, or political alignment. Ownership is absolute, and settlement is final, which is a rare feature in a world built on interconnected promises. Another hook worth recognizing is that gold is not chosen because it performs well in stable times, but because it performs when stability is questioned. Central banks do not buy gold for short-term price appreciation. They buy it to anchor confidence during periods of monetary uncertainty. Gold's value is derived from scarcity, durability, and universal acceptance, qualities that have survived centuries of regime changes, currency reforms, and financial resets. When trust in paper assets weakens, gold does not need to be explained. It is already understood. Gold also functions as a strategic hedge against currency debasement. When governments respond to rising debt and economic stress through monetary expansion, the real value of fiat currencies declines. Gold, which cannot be created at will, adjusts instead through price revaluation. This makes it uniquely effective at preserving purchasing power over long periods, even when nominal economic indicators appear stable. The hook here is subtle but critical. Inflation is often managed statistically, but gold responds to reality, not narratives. From a geopolitical perspective, gold enhances monetary sovereignty. It allows nations to settle trade, diversify reserves, and maintain financial resilience without reliance on external systems. As global trade becomes more fragmented and regional alliances strengthen, a neutral reserve asset becomes increasingly valuable. Gold bridges competing systems because it belongs to none of them. The growing accumulation of gold by central banks is therefore not a reaction to crisis, but a preparation for uncertainty. It reflects an understanding that in times of transition, resilience matters more than optimization. When the goal shifts from maximizing yield to preserving autonomy, gold naturally moves from the margins back to the center of reserve strategy. The surge in central bank gold accumulation is one of the most underappreciated signals in the global financial system, precisely because it lacks drama. There are no emergency announcements, no urgent press briefings, and no public warnings. Yet history shows that when central banks act in unison, quietly and persistently, they are responding to risks that have not yet reached public consciousness. The first hook is this: institutions tasked with preserving stability do not chase trends, they anticipate stress. Central banks operate on multi-decade horizons. Their objective is not to outperform markets, but to maintain confidence in national balance sheets under a wide range of scenarios. When these institutions increase gold holdings, it reflects a reassessment of tail risks rather than a short-term view on prices. Gold serves as an insurance asset against outcomes that are difficult to model, but devastating if ignored, including currency realignments, financial fragmentation, and loss of confidence in sovereign debt markets. Another hook lies in what gold purchases replace. Central banks are not adding gold in isolation. They are adjusting away from assets that depend on uninterrupted market access and policy credibility. Government bonds and foreign currency reserves perform well in stable, cooperative environments. However, when financial systems become instruments of geopolitical strategy, reserve assets inherit political risk. Gold, stored domestically and held outright, neutralizes that vulnerability. It cannot be frozen, diluted, or blocked from settlement, making it uniquely suited for an era of strategic competition. This accumulation trend also signals a deeper concern about the effectiveness of conventional monetary tools. Ultra-low interest rates, quantitative easing, and balance sheet expansion were once viewed as extraordinary measures. They have since become recurring features of crisis management. The repeated use of these tools raises legitimate questions about their long-term consequences, particularly regarding currency value and financial discipline. Gold becomes a hedge not against policy failure, but against policy exhaustion. There is also a psychological dimension to central bank behavior that is often overlooked. Confidence in a monetary system is partly constructed through perception. By holding gold, central banks reinforce the credibility of their own currencies, especially in emerging and transitioning economies. Gold acts as a symbolic anchor, signaling restraint and preparedness. The hook here is subtle, but powerful. Trust is easier to maintain than to restore. What makes this trend especially important is its persistence across economic cycles. Gold buying has continued through periods of growth, tightening, and volatility, suggesting a structural shift rather than a reactive one. When institutions with no incentive for speculation steadily increase exposure to a non-yielding asset, it indicates that resilience is being prioritized over return. In global finance, that prioritization usually precedes periods of meaningful adjustment. The gradual fragmentation of the global financial order is no longer a theoretical discussion reserved for academic circles. It is unfolding through measurable changes in trade, finance, and reserve management. For decades, the system functioned around a single center of gravity, with the dollar acting as the primary medium of exchange, store of value, and unit of account. That structure delivered efficiency, but it also concentrated power. The hook here is clear: systems built on concentration are stable only as long as trust remains unquestioned. What is emerging instead is a more multipolar framework, where financial relationships increasingly align with regional, political, and strategic interests. Trade agreements are being settled in local currencies, alternative payment systems are being developed, and reserve diversification is accelerating. None of these shifts alone dismantle the existing order, but together they dilute its dominance. This is how global systems evolve, not through abrupt collapse, but through incremental rebalancing that becomes undeniable only in hindsight. Another critical hook lies in incentives. Nations do not fragment the system out of defiance. They do so out of necessity. As geopolitical tensions rise, reliance on a single financial infrastructure introduces vulnerabilities that extend beyond economics. Access risk, settlement risk, and policy risk become part of every transaction. Diversifying financial channels becomes a form of strategic insurance, reducing exposure to disruptions that may have little to do with market fundamentals. This fragmentation also reflects changing growth dynamics. Emerging economies now account for a larger share of global output and trade than in previous decades, yet governance of the financial system has not fully adjusted to reflect that reality. As influence and representation diverge, parallel systems naturally develop. The hook here is subtle but powerful. When institutions lag behind economic reality, alternatives do not ask for permission, they simply gain usage. From a capital flow perspective, fragmentation alters how risk is priced. Assets once assumed to be universally liquid and accessible are now evaluated through a more complex lens. Investors must consider not only credit quality and yield, but also jurisdictional alignment and system compatibility. This introduces friction into global finance, but it also redistributes power, gradually shifting leverage away from centralized structures. Perhaps the most important insight is that fragmentation does not imply disorder. It implies transition. Multiple systems can coexist, overlap, and compete, each serving different priorities. However, transitions create inefficiencies, and inefficiencies create repricing events. History shows that during such periods, assets and currencies are revalued not based on past dominance, but on future relevance. The global financial order is not ending, it is being rewritten, line by line, by those positioning for what comes next. Large-scale capital reallocations rarely announce themselves with urgency or emotion. They unfold through disciplined decisions made well ahead of visible stress. Sovereign investors, institutional funds, and central banks operate with one overriding priority: preservation of long-term value. When these actors begin adjusting portfolios, it is not a reaction to headlines, but a response to shifts in underlying assumptions. The first hook to recognize is this: the most important moves in global finance happen before consensus forms, not after it. History consistently shows that early capital movement precedes major wealth repricing. Before inflation becomes entrenched, before currencies are questioned, and before market volatility spikes, sophisticated investors quietly reposition. They reduce exposure to assets whose future returns no longer justify their risks and increase allocations to assets that offer durability across multiple scenarios. These transitions are gradual by necessity, but their impact is profound. By the time the rationale becomes widely accepted, valuations have already adjusted. Another hook lies in the asymmetry of information and timing. Large institutions have access to deeper analytical frameworks, longer time horizons, and fewer behavioral constraints than retail participants. They are not pressured to act quickly, but they are also not waiting for confirmation. Their decisions reflect probabilities rather than predictions. When capital begins flowing away from traditional debt instruments and toward hard or alternative assets, it signals a reassessment of long-term stability, not a short-term market call. Wealth shifts are rarely driven by sudden collapses. They are driven by gradual erosion. Purchasing power declines slowly, confidence weakens incrementally, and risk premiums expand quietly. This slow motion process often creates complacency, allowing those who move early to secure advantageous positioning. The hook here is uncomfortable, but necessary. Waiting for clarity often means paying a higher price for safety. This dynamic also explains why public narratives lag reality. Policymakers and markets tend to frame transitions as temporary or manageable, while capital reallocates in anticipation of structural change. Early movers are not attempting to time peaks or bottoms, they are reducing vulnerability. In periods of transition, resilience becomes more valuable than optimization, and protection outweighs performance. What makes early reallocation especially powerful is its compounding effect. Small adjustments made ahead of major shifts accumulate advantages over time, preserving optionality and flexibility. Those advantages are invisible in the early stages, but become decisive once repricing accelerates. In global finance, wealth is not transferred in moments of chaos alone. It is transferred quietly through preparation. And by the time the shift becomes obvious, positioning is no longer a choice, it is a consequence. So understand this moment. China and Russia are not attacking the system, they're hedging against it. They're voting with capital, not speeches. And capital is brutally honest. This is a reminder that money flows toward certainty when the future feels unstable. And right now, gold represents certainty in a world built on promises. The question isn't whether this shift matters. The question is whether you're watching it from the sidelines or learning from it. Because history doesn't send invitations, it sends signals. And this one is loud enough for anyone willing to listen.